Today we will see how to trade breakouts. It is possible to make money easier, or is just a myth. The market seems to break violently above or below certain price areas. Even though this seems to be very juicy and profitable, predicting and trading successfully the next breakout is not so easy. But first things first, a breakout occurs when the price breaks out either higher or lower than an area of consolidation, support or resistance. When the prices are consolidating, the market gains momentum. As buyers and sellers are in an agreement, what we should expect is the prices to spike. There are some key areas when the market breaks those prices. Most buyers or sellers will dive into the market and the breakout will occur. As the volume of prices increases, then the market is breaking the previous supports or resistances. Most of the time the market will keep going in the same direction as the main trend. As we said several times, trend is your friend. If you go back to the episode regarding market orders, you will understand now why we use a buy above order or sell below order. When we are trading FX market, there is no way to know the exact volume. A very popular indicator is the OBV. The OBV was introduced in 1963 in Granville's book, New Key to Stock Market Profits. This technical indicator is considered the most popular to measure the volume. We will analyze this particular indicator in another episode, but for the purposes of this video, you should know that there is no way we can measure the real volume in FX markets. Also, at this point, we need to explain volume and volatility, as these are two different things, but they are correlated. Volume, in simple words, is the number of contracts for a particular period. Volatility is the rate at which the prices of a financial instrument increases or decreases over a period. As the volume will increase, the spreads will converge. We have done an entire video for those topics and you can find the link in the description. What we need here is volatility, and you will see why. Goes without saying that when volatility increases, the prices start to swing. I understand that as beginners you need more tools to measure it. In this case, what you need to use are some indicators. We have analyzed all of them in this series, so you can always go to the relevant video and check for more details. Some of the most popular are average true range, Keltner indicator, Bollinger, Donchian channel, relative volatility index, Chaikin's volatility, and several others that will make things more complicated. Now let's see how to use them. Traditional moving average is here again. Use the recommended values we have explained in our videos. A very nice combo with that indicator is also channel indicators, Bollinger Band, Alligator, envelopes, Keltner, and so on. The idea and the way to use is very simple, but again, not perfect. You already know that I'm a super fan of golden ratio, so alligator is what I suggest. But again, any channel indicator will work fine. The list of those indicators is huge. As long as you are able to understand the basic principles, then you won't need our videos to do that. When the basic indicator lines are starting to diverge, then the market is making the move. A breakout is happening. Unfortunately, the drawdown is that indicators will detect that too late. A good confirmation is also at least 2 or 3 engulfing candles, but again you might lose the entire move. You can also wait for the retracement to enter. At this point you can combine your entries. The first entry, the potential breakout, and the second one that will average your positions in the retracement. The stop loss will go to the bottom or the top of the channel. Also pay attention to the higher time frames before entering the market. There are two types of breakouts, trend continuation breakouts and reversal breakouts. The principle is the same. When the market starts consolidating an area, one of these two will happen. Unfortunately, we don't know for how long the market will stay there. And of course, when the breakout will occur. Continuation breakouts are most common as the market most likely will keep going with the trend. At any direction, when the market approaches previous supports or resistance areas, is where we need to look for our next trade. Very important tools are the golden ratio and Elliot waves. A reversal breakout will occur again in some specific areas of either strong supports or resistances. The market always leaves clues. As the market goes into a direction, at some point it won't be able to proceed further. As the market is running out of steam, instead of going in the same direction, it might jump to the opposite direction. Strong allies are technical patterns and some more advanced harmonic patterns. For example, some clean double or triple bottoms or tops. and some golden ratio retracement utilizing the use of harmonic pattern. We do not recommend trading reversals, but you need to know that reversals will give higher profits. Risk comes always with a reward. The next we will see are fakeouts. In Forex market, nothing is written in stone. A proper risk reward and money management are what you need. The market is unpredictable. A fakeout is simply when the market just spikes for a short term in those key areas, but eventually we have no breakout. Where we as traders fail is when the market eventually tricks us. No matter what indicator you are using, this will be unavoidable. Several times the market won't be on your side. Simple fake out is when the market seems to break out but returns back. As a rule of thumb is not to enter the market right away. Most new traders believe they will lose the prices or the market will reverse right away, or that they will lose a very juicy trade. You will not be able to go far with that mindset up. Trading a breakout is not so easy, but let's see how you can trade them and how you will be able to increase your success ratio in those cases. At this point, you need to have mastered some basic skills like trend lines, basic technical patterns, and channels. You will find all the relevant videos in the description to help you with those information. Always try to execute your trades to go along with the trend. We will keep repeating this in every episode. The first thing you need to pay attention is some basic chart patterns. Double tops, bottoms, triple tops and bottoms, head and shoulders, crown, diamonds, and so on. The market might consolidate in an area without creating any technical formation. In Forex, nothing is written in stone. Trend lines are also strong allies. Trend lines are the most important tool to help you with that. Recognizing the market structure. Simple, basic rules. At least 2 points to have a trend line, and do not imagine things or adjust your lines. When the prices approaches your trend line, only two things can happen. The prices could bounce off the trend line and continue the trend, or the price could break out through the trend line and cause a reversal. We want to take advantage of that breakout. A simple use of a popular indicator like MACD is what you need. In this example, the market breaks and our indicator helps us to shoot the market. Ideally, a golden ratio retracement is what we want. Channels that goes side by side with trend lines is another way to spot breakout opportunities. Drawing trend channels is almost the same as drawing trend lines. Channels are useful because you can spot breakouts in either direction of the trend. The approach is similar to how we approach trend lines. In this case, we wait for the price to reach one of the channel lines and look at the indicators to help us make a decision. Unfortunately, the market might create a channel inside the channel as part of the retracement. Again, nothing is perfect. You can set a break even to avoid that situation. Not losing in trading is even more important than winning. The 90-90-90 rule is a hard reality. Technical patterns like triangles are very useful also. They offer extremely juicy trades and high risk rewards. My suggestion is to go back and check the triangles: ascending, descending, and symmetrical. Triangles will help you as long as you don't force your lines. We have explained in these episodes how triangles can be hindsight, and the market structure is ideally to create infinite triangles at any given time. Ascending triangle is an indication that the market will reverse. A fast recap: we have an ascending triangle each time the price reaches a certain high. Several traders also convince and they sell at these levels. The prices are dropping back down. On the other side, several traders believe the price should be higher, and as the price begins to drop, buy higher than its previous low. The result is a struggle between the bulls and bears, which ultimately converge into an ultimate breakout. A breakout to the upside is what we should expect, since ascending triangles is generally bullish signals. When we see a breach of the resistance level, the proper decision would be not to go long. Why? Because we need to go with the trend. In any case, as traders, this will be a decision you will have to take. Descending triangles are basically the opposite of ascending. An ideal descending triangle is what we want to see in a downtrend. A breakout with the help of an indicator is what we ideally need to execute the market. Again, go with the trend. Symmetrical triangles is the last category, the third type of triangles. With symmetricals, usually we don't know where the market will go after the breakout. A most favorable option would be to go with the trend again. As we said, we have two types of breakouts, trend continuation and trend reversals. We strongly recommend to go with the trend, but again, this is up to you. When you will enter the market, you need to know when is the proper time to leave the trade. We need to take advantage of that breakout and book some profits. Most indicators can help you with that decision. As soon as you see that your indicator is running out of steam, or if you start noticing divergence, it's time to leave the market. Take notes at this point. You use a stop loss, take profit. The reason is that you need to maximize your profits. We will cover in another episode how to follow your trades and adjust the profits. MACD, RSI, stochastic can show you the market conditions and when to leave the market. At this point, do not overcomplicate your trading. You need to create your own simple rules. As new traders, while you are building your strategy, you need to set up several of them. Using indicators is ideal for beginners. Be ready when the market loses momentum. Also, you can use moving averages to help you with that. When your MA, for example, crosses the prices, you need to be ready to abandon the ship. Momentum indicators are the key to measuring the breakout at this point. Alligator is another good option. Bollinger, ribbons, and so on. Also, pay attention to patterns, golden ratio extensions, and Elliot. As our series approaches the end, we will demonstrate full live videos, even though you can find our trades in our live channel. Again, trading is really risky, and we do not recommend follower trades. Stay in the demo until you feel confident to face real markets. RSI is another momentum indicator that is useful and very popular for confirming reversal breakouts. By spotting this divergence, you can find possible trend reversals. However, RSI is also good for seeing how long a trend has been overbought or oversold. Remember, these overbought and oversold are not real. The market might stay overbought or oversold for eternity. If a trend has produced oversold or overbought readings for an extended period of time and begins to move back within the range of the RSI, it's a good indication that the trend may be reversing. Any good use of the above mentioned indicators is considered a good practice to book your profits. Also, removing a big portion of your positions and leaving some small percentage is another good way. One suggestion before starting to experiment with these details is to stay to the basics. Breakouts are very popular among traders, no doubt. However, the market is full of scams and tricks. It's like that beautiful Insta photo that looks like Victoria's Secret model. So now you know the secret. It's used to be a victor. Fakeouts are very common in the markets. The market will spike and you will think it's time to dive. Here you will see some tools you can use from your side also to avoid it. Don't dive into the market right away. Wait for 2 or 3 candles as confirmation. You can always enter in the retracement of the breakout. If the risk reward is not so good, do not enter the market. A fakeout most likely will happen to the opposite direction. This is the reason we said to not trade opposite to the trend. Also, a very important factor, make sure there is no important news like interest rates, unemployment, non-farm payrolls, and so on. You can find all the relevant information in our fundamental analysis video. In those cases, you might see some huge spikes in the market. Support and resistance levels are also important. The market will respect those areas, so keep them in mind before entering a breakout. It might be a fake out as the market approaches a significantly bottom or top. We never know where the market will go. Fake outs will trick you. Any kind of confirmation won't be enough. However, you need to enter this trading hunting game with the most sharpened tools you can get. To sum up the breakout story, we have highlighted some pros and cons. Breakout trading has created many successful traders over the past few decades. Identifying correctly the next breakout can be very, very profitable. Breakouts help traders capture the beginning of a new trend in the market. When you are trading the reversals, a very juicy trade might be waiting for you. This is a double-edged sword. The reason, as we explained, is that we want to go with the trend. Easy technical analysis concepts, especially for new traders, with some basic indicator knowledge. Indeed, you can start trading right away. Breakouts can be used in several time frames. This can give you advantage to trade them in multiple time frames and generate several trades. Breakout trading can be used no matter what market you are trading. Breakout offer potentially great risk-reward trades, especially triangles can give you some huge risk rewards. The cons or disadvantages of trading breakouts are: breakouts can create many false trading signals. Most new traders suffer from fakeouts. You need to have a very good knowledge of the market before using them, even though they seem very appealing for new traders, as we explained. Can have a low win rate due to extreme accurate and the tight stop losses you will force to use. Breakouts can cause overtrading for novice traders and eventually ending up trading for your broker. That's it. Thank you for watching. Go back, repeat the chapters you are not sure, and trade safe.